what we're going to do tonight is still kind of a extension of, I get tons of questions about option trading using candlesticks, which to me is very lucrative because doing is putting on systems or putting on strategies that dramatically improve the probabilities of not only being in the right direction, I shouldn't say it that way, knowing that when we analyze the candlestick charts, we've got the probabilities moving in the right direction. Now, using options, which is just one method of controlling the stock, we've got some great advantages if you use the appropriate trading strategy with the correct price pattern or the price movement. So tonight we're going to kind of concentrate on spreads because this is all kind of leading up to our September 7th training. And as I go along, it might be September 7th and September 8th because of the amount of information that we've got, that's good information. So tonight we're going to kind of concentrate on spreads because if I am trading, I would say 90% of the time I'm either buying calls or puts, but a vast majority of the time I'm probably putting on spreads. So we're going to kind of concentrate on that tonight just to show you the advantages of a spread versus just buying calls or puts outright. So we're going to work on the bullish spread, and bullish spread works much better when the upside potential of a move makes calls alone too expensive for that price move. And what do we get that out of the candlestick signals and patterns? At least it produces price moves where we can evaluate with a high degree of probability based upon the historical results, obviously, of the candlestick charts that we're going to be heading in the right direction. So this allows us, based upon some of the different patterns, of putting the appropriate option strategies in place. So just simply stated, candlestick analysis for me has always been a high probability of being able to analyze the direction of a price move, the timeliness of a price move, and the magnitude of that move. So what this does is, because of the simple graphics of candlestick, we can have much better timing and we at least know where our targets are going to be. Now there's different criteria, at least in my case, of when you want to use spreads. Now if I know I've got a long time before expiration, let's say 3 to 4 weeks out, I'm probably just buying the calls or puts outright. If it's 2 or 3 weeks out, you get debit spread, and then if it's that final week, it's usually a credit spread. Now the reason for that is, working backwards, is a credit spread doesn't make you a whole heck of a lot of money. But based upon identifying what a candlestick chart is telling us, the probabilities of making money with that trade is extremely high. The reason we only go 2 to 3 weeks before expiration on a debit spread is because there's one disadvantage of having a price move in the direction that you want it to, and you're in a debit spread. And that is, if the price move is too strong, too fast, because you bought the lower priced call and sold the higher priced strike price call against it, if the price moves real big, more than likely the higher priced call that you sold is going to move up percentage-wise faster, because obviously that's going to be the one closer to being at the money, which is what a lot of people try to do, is buy at the money or out of the money calls to speculate. So usually they're going to move as a bigger percentage, which means you could be in a trade that is moving in the right direction, but the equity of your spread is going negative, meaning at a loss from where you paid for it, just because the upper price option is moving up faster than the lower price one. And then, so that's why I try to keep the spreads usually in about a 2 or 3 week time frame. So, for those that have asked what is a spread is a position entered by buying and selling equal number of options in the same class of the same underlying security, but at different strike prices, which means if a stock's trading around 50 and you're buying the 50 calls and you're selling the 55 calls against it. And the reason for that is the leverage. So if we've got a stock that's trading at 50 and our target is 55, let's say we're buying the 50 calls for $2.50. Well, if it hits our target, that means that $2.50 has gone to $5, or you've made $2.50 profit on that trade. And just to break even, if that stock was trading at 50, stock had to go to 52.50 just to get you 250 back, the premium you paid on that for that option. Let's just say what? Break even. Now, if you do a spread where you're buying the December 50 calls for 250, and then you're selling the 55 calls at what you think the target's going to be for $1, you're basically pulling $2.50 out of your pocket, and you're putting $1 back into your pocket, so your net result is that you've only got $1.50 in that trade. Now, if it goes to your $55 target, and it goes to $5, you've made $3.50 versus the $2.50, meaning your profit at that point is, I think that is right, 275% gain versus 100% gain. So can everybody see that math? That we're putting money back in our pocket. Now, a lot of people ask, well, what if it goes to 60? Well, obviously you've cut off your profit potential. Well, I have been in an option trading ever since they came out with options back in 1976 or so. 233%. All right, thank you, Jeremiah. I forgot what I was saying. Oh, I've been trading options ever since I was a stockbroker at the ripe old age of 21 years old back in 1976, and that was just about the time that options on different stocks came out. And like any investing, very rarely do you have a situation where your uptrending stock just skyrockets. It always kind of moves up in oscillation. So the relevant decisions that we make about buying options is how much time do we have to miss the initial example was the straight call, yes. Okay, let me finish this. How much time do we have for expiration? What is the strike price that is the best one that we want to go after? Or what combination of those? All right, let me go back to this initial one. We have a stock at 50. And let's say at the time we were looking at the calls and they were trading for $2.50. Well, if the stock goes to our $55 target, that means our $2.50 is now the calls that we bought for $2.50 are now $5. So we've made $2.50 profit on our $2.50 investment, or we've made 100% profit. SP, we don't know if that's a good risk reward. When I have something better to go after, that's where a spread comes into effect. That I'm buying the, I'm buying the 50s for 250, but I'm selling the 55s at my expected target, which means I'm putting $1 back in my pocket. So I've only got $1.50 out of pocket. Now if it goes to my 55 and that all goes to $5, I've made $3.50 versus $2.50, which has a couple benefits to it. Let's see if I've got a couple benefits. The benefits are the leverage is better, your break even is lower, where the break even on the calls outright, the price of the stock had to go to $2 or $52.50 just to get your money, just so you could get your money back at $2.50. Whereas on the spread, it only had to go to $51.50 to get the $1.50 you had involved. So your break even is lower, and then on top of that, you've got less money at risk if the trade doesn't work out. Okay, didn't get everything. So trading options has two vital aspects to it. One, obviously, we want to see what pattern we're working with to see what it might go to in a specific time frame. And two, that means we want to be analyzing the math of that trade. And this is where most people kind of fall by the wayside, is they see something that's going up and they want to buy the calls. Well, the calls may not be an effective way to make a profit on that. Spread might be much more conducive. So if I can judge what my target is, like we can see in a J-hook pattern, that if this is wave one, there's my potential target up here. But if I'm buying a calls, I might be more apt to go ahead and buy a spread, knowing what my upside is. We got much more advantage of knowing what a price move could do based upon the specific patterns that we're analyzing. Now, when I'm doing a spread, I'm usually looking for something that's going to return anywhere from 2.5 to 3 times my money. Meaning, if I'm buying a spread that's worth $5, if it executes properly, I don't want to have any more than $2 into that price move or into that trade. So the benefit we have when we put on a spread versus a straight call is the math is better and the risk is lower. So now what we need to do is figure out what is the best strategies for the different patterns. If we've got a fry pan bottom breakout, we know what to expect here. Maybe buying the calls outright. However, we know that if this is our expected move, or anticipated move, a big move coming out of a fry pan bottom, our best strategy might be to buy some calls, and maybe we do a spread up here. And I'm just going to throw some numbers out. Let's say we're buying some calls outright for $1.50, expecting them to go to maybe $8. Or we pick or we pick a spread up here, where we might be buying a spread that we've only got this far away from the price move. And you only have 60 cents in that spread, with the idea that if it does come up through the top of that spread, our 60 cents has now gone to $5. Obviously, a good leverage trade. Now, what's the ramifications if it doesn't get up through here? Well, hopefully, if this works a little bit, that the calls are making us a profit, more than enough to cover that 60 cents we added to even enhance the returns on that spread. So these are the type of things that that we're going to go over as far as what is the best. Is there a known failure rate? No, CB. The failure rate is based upon knowing how the failure rate is a function of assessing what the market is doing and then assessing which is the strongest of your candlestick trades. How quickly does a bull call decay? Well, that's all, again, depends on how far away you are from the expiration date. I think I might have. Yeah, there's no way of knowing that either. Now, there are formulas that you can look at and see when the time value of that call accelerates, or the time decay accelerates, and it's usually, if I've got something that's expiring on a Friday and the market doesn't look great, I'll try to close out that trade on the Friday before expiration, because just the psychology is, well, we've got another week to go before expiration, but Monday, what's that psychology do? It now says, oh, it's going to expire this week, we're pretty close. So the price of those options kind of drop a little bit faster as soon as you get to the next week. How do you decide on strikes, straight calls, and spreads? That's exactly what we're going to be going through. That's going to be probably a 30-minute to 1 hour dissertation on the training. You can't close them to take profit until the market opens. That's probably the same true with the stocks. Okay, so we have the ability with candlestick analysis to identify what our big price moves might be. We also have situations where we can see what pattern is setting up, so we know the exact timing to get into a trade. So I might not be buying calls, but as soon as it breaks out, I'm buying calls because I know there's now a new target that we've got wave 1, wave 2, gone into wave 3. Again, J-hook patterns give us those potential targets. That allows me to say, well, if I'm buying right here and I'm going to buy some options, I'd be better off buying some calls, selling some calls, because the leverage is much greater, and I'll try to show that here in a minute. So when we have price move expectations, we want to add the math factor. So if we're watching these, I don't know whether I did this here. If I'm buying the March 1700 calls in Amazon right here, with my expectation that it's going to go up and hit the 200-day moving average, that means I'm paying $9.30 to go up here, so those options go to 30. So that's why I want to know whether my math is much better buying straight calls or buying a spread. So if I go buy a call at 9.30, it goes to 30, I've made $20.70, or a 222% profit. Or if I had bought a 1700/17 spread for $1.80, now the math has a much different perspective. The price only has to go to 1710 to have that $1.80 now go up to $10, or $8.20, or 450%. I think that's a 455% profit. So two things happen. One, my leverage was a heck of a lot better to make a lot bigger profit. And two, it only had to go up 10 points versus 30 points to make a much bigger profit. So the same math would mean that if I was buying the calls at 9:30, Amazon would have had to gone to 17.51 to make the same percentage return as what the spreads had done. All right, what everybody's typing. So, yeah, to buy the spreads, they only had to go up to about here to make some good money. To buy the calls outright with that as their target, to make the same money that spread was going to make, the price of Amazon had to come all the way up here to make that same percent return. So, what do we have as far as flexibility on a spread? You can see what strike price. And that's the difference in figuring out, well, I think the price is going to move, so I might be better off just buying a spread that's going to expire 10 days out. So when you put on a spread or sell a put spread, which is another strategy, we're going to be looking at or having everybody kind of evaluate what is your own risk-reward tolerance. But the next aspect when we put on any trade is, what is the overall market trend? So if my assessment is the market's heading up and I see a breakout and I think my first target is up here, again, if I bought a spread, eliminate. Oh, I could buy the calls. Calls wouldn't be very effective if the stock had closed at 80, about 81. Not a big move. But if I can calculate the move and the spreads make sense, if I bought the 81s, sold the 83.50s for 91 cents, I know that if it goes up to 83.50, I think that's right, I'd have a 250 profit or a 250 or $1.95 or now $1.59 profit or 175% profit. Whereas if I bought the calls outright, I may have had a 30% profit. And price didn't have to go to 350 for me to break even. All I had to do was go to 81.90. So they only had 91 cents in it. So if it closed at 81.90, I could still sell that spread for 91 cents. Now, if I wanted to be a little bit more aggressive, maybe pick out something of 16 days to expiration and do an 83.85, because that was kind of what we were calculating, is that we could possibly get up here to $85. Maybe it would take, whatever I said, 2 weeks to get there. Well, maybe I go out and just buy the 83.85 spread for 27 cents. All right, what's my risk reward? Well, if it doesn't get to 83, I've lost 27 cents. If it does get to 85, now my 27 cents has gone to $2, $1.73 profit on 27 cents comes a 640% profit. So not every trade has to be done based upon like at the money calls or want to buy out of the money. A lot of times doing a spread makes a heck of a lot more sense, because if this didn't work, you had 27 cents on each contract at risk. If it did work, that 27 cents went to $2. That's a good risk-reward factor. So the important facet, again, is if we can recognize a pattern, anticipating what the initial move is and what the next move is, that we try to calculate where it might be over a 2-week, 4-week, 6-week time frame. And that's still a function of knowing what happens on a pattern breakout and what the strength of the move was prior to that pattern breakout. So these are all things that can be easily analyzed, and then we can put the math to our advantage. So a spread has less money exposed to market risk. The percent return is greatly enhanced at even a much lower price target, and the break even is much lower. So this isn't rocket science. This isn't something you have to sit there and calculate every night of what your return's going to be. It's very simple, and I'll see if we... For example, this is what happened today in NVIDIA. Now, why is this a good chart? Because if we just do our assessment of what the chart was telling us, which was we had a doji gap up, your best friend, which is also a Morningstar signal. This was also right here at the 200-day moving average, and it gapped up through the 50 and the T-line. Where do you think our first likely target might be? Probably at least coming up here and testing the recent high. We've got a wave 1, wave 2, wave 3 up here somewhere. And then what was our initial trend before this consolidation? Looks like this. So there's a lot of analysis that we get just from the signal reversal pattern and the strength of that reversal signal. Again, our best friend signal, J-hook pattern, and it's doing it right at major support levels. So it becomes a high probability trade setup. Now, what is the first thing that we should be doing every day when we make our evaluation of whether we want to be going long or short? Would you point out where wave 3 begins? You can put it anywhere. This is wave 1. Maybe right in here is wave 3. Are you timing the spreads so that the ideal goal is that short leg is near zero at expiration? Not necessarily, Deborah. What we're assessing about the target is, where is the target? So the upper leg or the selling of if a stock we think is going to 55, that's what our first target would be. All right, so we're buying the 50, selling the 55. So the question is, a lot of times, what happens if it goes to 65? Well, you've got a piece of paper that says you're allowed to buy the stock from somebody at $50, and if it's at 65, obviously that piece of paper is worth $15. You've also sold a piece of paper that said somebody is allowed to buy that stock from you at 55. So if it's at 65 and you had to buy it back, how much would you have to pay for it? $10. So you've got one that you could sell for $15 and you have to buy the other one back for $10. So it doesn't matter what price it is once it goes past your 55, because it's always going to be your maximum profit is $5. So the upside potential of a spread is you get better leverage, lower break even, less money at risk. Your disadvantage is if all of a sudden that stock blasted off to 70, you've limited yourself to $5 profit. The one that you bought at $2.50 for $50 would now have gone to $20. But again, what happens is the risk reward is that to make that same percent return, or to make a good percent return, you're much better off in a spread. To answer your question, the first thing we should do is determine direction. No, that's the second thing, okay? When do you lose with a spread? The maximum you're going to lose is if you bought the 50s at $2.50 and you sold the 55s for $1, so you had $1.50 out of pocket. That's the maximum you would lose. And your maximum you would lose would be if the stock was trading below 50. Because as long as it's trading above 50, you're going to get some of your money back. As long as it's trading above 51.50, you're going to get all your money back. That's your break even. You do have the flexibility to close one side, but you've got to remember, if something like that happens, now the whole purpose of putting that spread on disappears. Now you're just closing out one side so that you could be long. And we will go, I'll try to get it back. We're on 40. I'm going to go back up here a ways. On this one. I want to do the spread. All right, let's say the stock did move from 50, and we've got 4 days to expiration, and the stock was trading at 54.50. Well, now you look at it and say, all right, my options at that time are trading right around $4.60. I'm just picking out a number. We've still got 4 days to expiration where you're going to maximize your profits, because if it's trading above 55, it's going to be the difference between the 50 and the 55, which is $5. The reason it's maximized on expiration date is because there's no premiums left, time premiums left in those options. So the other side of the math question would be, if you've got 4 days to expiration and the stock's trading at 54.50 and you can get out of your options at 4.60, or that spread at 4.60, so instead of making $2.50, you're making $2.10. Now the equation becomes, all right, is it worth it for me, depending on what the market looks like right now, to hold this for another 4 days for another 40 cents? Or am I better off closing it out and taking that money and going and finding a better situation? And that'll be another equation that we'll be working on. So everything we do as far as getting into a spread or coming out of a spread is based upon the math. Is it worth sitting in a spread if we've got most of our profits and now we're sitting just waiting for it to maximize out and it's another few days away and there's still risk for doing that? You can always buy it back, yes. And I'll show you how to do that. It's just as like anything else. When you, and I'll get here to that one. This one. All right, so Jay, the answer to the true answer is the first thing you want to do is analyze what is the market doing. So if I'm looking at putting on spreads or buying calls or doing some option trades on NVIDIA because it's got a very strong chart, obviously I probably wouldn't be aggressive on that trade if the market looked like this. It was just starting to roll over. Right now we're looking at a market that looks like this. Now, what is our assessment of this market? We've been moving sideways for the last 4 weeks. Now we have a bullish engulfing signal and a gap up and we're nudging the top of that sideways trend. So our first assessment is, what do we need to see to tell us that there's a good, strong, bullish market going on? First of all, we want to make sure we're getting out of this whipsaw area, because what did this whipsaw area tell us? It told us pretty much that people were buying and selling based upon each positive tweet or each positive or negative announcement each day. So what tells us that syndrome would have changed? So if they open the market tomorrow positive and they break out through this level, which is something everybody else can see, it tells you there's probably a different investor sentiment involved now in the markets. Now, on the other hand, if this happened to open down here and started trading down, what would we want to be doing as far as any bullish option trades? Probably nothing just at that point. So our assessment has to be, if this market opens positive tomorrow, what do I want to be doing? Do I want to be aggressive and buy some of the, I've picked out the September 13 calls time frame, 15 trading days, just do I go out and buy some of these? Yeah, I could. Or what is my price target? Well, today it closed at 167. It's got the potential of coming up here. What is the math on each one of the spreads? Well, I might take a look and say, all right, if I bought the 167.50s and sold the 172.50s, the $5 difference, the $2.31, that doesn't quite reach my parameter for risk reward. I want to be below $2. What if I buy it at a 170, 175 for $1.84? That makes a little bit more sense. And where is a 175? That's just great. I'm going to have a hard time finding it. 175 is going to be right in here somewhere. Can it get there based upon this signal? Yes, probably. Because if it's going to, this is our first target, it probably could get up there. You can also sell a new short call to lock in profit if it's moving that fast. Yes, you could always do that. Now, I don't get that sophisticated. I want to keep my trading as simple as possible. So if I do have a situation where things have moved way too fast, yes, that's what will happen. I'll put on some protective puts. So I might go after these. Again, this all says what strategy or what trades fit into your parameters. Oh, I don't know. Again, this is just kind of generalization that if this is 167, maybe 175 is up here. Is it viable that it could get there? Definitely. Now, what makes the most sense numbers-wise? Well, if I'm paying $1.84 for this to go to $5, that's a good rate of return. $2.31 to go to $5 is a little bit more conservative, but that doesn't fit into my risk-reward parameters. Now, I say my risk-reward parameters. Everybody should come up with what they think is their risk-reward tolerance, what they feel comfortable with. Now, the reason I've picked out that I don't want to spend any more than $2 for a spread that could go to $5 is because of the hurdles that you have to get through when you're buying options. First of all, your bid-ask spread is going to be, percentage-wise, pretty substantial. And the commissions for a less dollars amount is usually a bigger percentage. And then, on top of that, not only do you have to be right in the direction of the trade, but you also have to be direct in the direction of the trade and the magnitude of the trade. So if I'm going to buy something where I'm expecting to make 50 or 100% double my money, I've still got hurdles to get through. I want to have a little bit more padding than that before putting on a trade. Nancy, it doesn't matter, whatever you're comfortable with. Now, if I think something is going to move decisively, let's say for some reason we thought that NVIDIA could shoot up there in the next 3 days. Well, I might buy a much shorter time frame calls. If I thought it was going to move up in this kind of move, I might go out a little bit longer. And that also is a function of what is your risk tolerance. Maybe you want to give up a little bit of quick potential returns for the safety of having a little bit longer for that trade to work out. Or if I want to really go out, maybe I go up to 175, 180, and I've only got $1.12 in it, with still the prospect of it could possibly get up here close to the 180 level, and now that $1.12 turns into $5. Again, much bigger rate of return. Or what strike price? This is always the question of which strike price is the best. Well, that becomes a calculation of two factors. One, how aggressive are you as far as your own risk tolerance? And two, which ones make the most sense math-wise for the price move that we can calculate? Kim, that's all right. We'll keep everybody here all night. Just ordering pizza, ham and egg. Do you reckon can do a combination? Yes, that's what this is getting to. Is that I might buy these calls and I might buy this spread. Again, if I got $1.12 in this and I bought these spreads, and I can't see the number, but let's say they were $5.40, and let's say this price move did move somewhere up in this range, and it didn't make my 175, 180 any money. Let's say this, when we closed it out, was at 40 cents. We were down 80 cents on that trade, but hopefully the calls were up enough, they covered that 80 cents and still made a profit. What we're doing with this spread, though, is if we think the price is going to move pretty big, we've got the safety of the calls and then the speculation that this $1.12 could go to $5 or make you about a 375% profit. We also are going to be working on what do you do with this type of strategy? What is the best risk reward as far as an option strategy when we can see a failure like we saw in Smuckers the other day? What are the different strategies we put on after the trade? Or a lot of people say, well, do you buy things going into earnings? I might look at something like this, and I'm just picking this out as an afterthought. Right now, they reported their earnings, but let's just say like Amazon or Apple or one of those that when they report earnings, they blast one way or the other, but we don't know which way it's going to be. Is a straddle or is a spread straddle the best criteria? After the earnings report, right now it's trading down here tonight at this level. So if we've got something that we're looking for big moves, and we were getting ready before earnings, do we buy the the stock closed at like 337? Do we buy the 365s for $5.50, or the 370s. No. Oh, the 360s for $6.70, somewhere in there. Well, that's still a hefty chunk of change. And do we buy puts for about the same price? If it dropped down to 315 or below, we're making money. What that means, though, is if we've got $12 in this trade, I kind of even did this wrong. That means the price has to move past that strike price by $12 because I paid $6 for it, plus I've got $6 I did on the call side. So it has to move a big percentage just to make my money back. Or, let's say I look at the 365 call spreads, instead of paying $6, go 365, 370 for $1.20, and buy a put spread, the 312.50 and 307.50 for $1.10. Well, now that puts a whole different dynamic. Whoops, I did that wrong. That if I bought the calls outright, and these are even wrong, this should be even lower. Break even for each of these might be down in this range because it's got to make back the money for the call plus the money for the other side. I think they call that could be an iron condor, and the reason I don't know the term so much is because I was doing this stuff back in the 70s, and they didn't have names back then. So I thought when they started calling them an iron condor or that type of thing, they got much more sophisticated, and I realized when I looked into it that they were all the same thing. So if I'm looking to say, wow, this is going to move big, and I bought calls and I bought the puts, the price may have to move to these ranges just to break even. Whereas if I did the spreads, the break-evens are going to be much smaller to make money on that same scenario. Yeah, so the other side of the coin would be that if I did the spread and the prices had to move to these levels to break even on the just buying the calls and puts outright, that if they move to this level, one way or the other, you'd still have about a 340% profit because of the leverage of that trade. So there's major advantages of being able to buy spreads, and this is what we're going to be going through on Saturday and possibly Sunday. And it's not going to be difficult stuff. And the reason is because I don't do difficult stuff. So I don't teach difficult stuff. Everything's going to be a very simple analysis of what to be doing and what makes the most sense. All you need is your charts and a little hand calculator. Okay, so that's about all I got tonight. And that's, again, the reason I like spreads, and I would say that probably 80% of the time I'm putting on a spread is because you've got less money exposed to the market. The percent return is greatly enhanced with much lower targets, and then your break even is much lower. So it's all based on math. Diana, this is going to be, if you took the January session, this is going to be kind of an enhancement of that. We're going to see a lot of the information that you saw in January, but now we're going to be spending probably 3/4 of the time analyzing, all right, which is the best strategies and going through the math on each one. So where the, I guess the January training was instructional. This one's going to be quick instructional, kind of reviewing all that, and then, I don't know if this is the right word, applicable. What is the best strategies to put on? So it's much more it's on hands application than what the January training was. Okay. With that, are there any questions? Oh, Becky, do you have a link for the session? While you're doing that, I've got them. Oh, okay, you beat me to it. I'm going to do this real quick. There's a few charts out there that, as I mentioned earlier, that I wouldn't put a whole lot of weight into going long or short based upon the fact that we haven't broken out of the sideways trading, but there are things that you can get ready for that would be very viable trade setup. So again, if we're looking at this market and we need to break out through this level to tell us there's a new investor sentiment dynamic, this one is probably the one I will write up tonight, is NVIDIA, because of the strength of this signal. But you also have lows. You can see that is a good J-hook pattern setup. I think Salesforce was another nice J-hook pattern setup. And Micron, piercing signal bouncing right off the 50, just about ready to break out. That if this breaks out, that's good potential of wave 1, wave 2, going into wave 3. The spreads, oh, no, the spreads aren't pricey. Oh, the spread on the bid ask for the stock. Well, if you do a spread, if I could pull that up. See if I can do this. Whoops, delete this. Thinkorswim has it very simple. Let's say I was going to buy the 167 spread. All you do is you come up here, you hit buy, come up to vertical. Now it brings up your price. If I was going to buy the 167.50 and let's say the 172.50, that was my $2.33. I don't have to worry about a bid ask. I just put that in and they try to execute it at that level. Now, once again, that's a little bit too hefty for me. So I might come up here and say, all right, I want to move up to the 170 and the 175 spread. For this case, it's now $1.94. That's the price. I don't have to worry about a bid-ask spread. They're going to go in and they're going to execute both sides of that transaction for approximately that level. Brad, again, the NVIDIA 165 to 175, 10 points. Same scenario as a $2 on a $5 trade or a $5 potential. I probably don't want to go any more than $4 on that to go to $10. Again, because of the hurdles that you have to go over. In this case, bid-ask is not there on a spread, but your commission charge, number one, which isn't real hefty, but you still have to be correct, and it still has to have a good magnitude. No, you don't use the stops for the spread price, Jan. You use your stops for analyzing what the, what have I done? Yeah, what I've done. You analyze what the price move does. So, for example, if we thought this was heading in this direction, and it came back and closed back below the T-line, and I'd already bought the calls, I'm closing out the trade because it's not doing what it's supposed to. We're not buying the price of the options. We're buying the options as a method for buying what the chart is telling us is the underlying stock. Now, you can do contingency orders. That let's say you can't be by the computer all day long. You can say, if this stock closes back below 194.90 where it opened, then close my option position. The only disadvantage with that is, that they're going to do it at the market. So let's say that you're probably going to get hit closer to the bid side, where, as if you were sitting here watching it, and it came back down, might try to get out at the halfway point in between the bid and ask spread. It would not be good to go long, say, on NVIDIA. Oh, CB, now you're not, yeah, that's not the point of putting on an option trade. I mean, you can do whatever you think you're comfortable with. You could be buying the calls, and then a combination of putting on a call spread. Okay, any other questions? Whoop, we're right at 9 o'clock. While we're here, we will take a quick gander at what the market index is. This is why we're in this indecisive stage till the NASDAQ can break out through the 50. So the most compelling chart that tells us we're close to a new dynamic is the Dow climbing right up here to the top of the trading range. Frank, I'm sure it must be. It must be. If all you need to do is email Abraham at candlestickforum.com and he can help me with that. I'm trying to think if there was. There's a little slow curve bobble breakout on MNTA. So that's a good, viable trade tomorrow. This one was looking good a couple days ago because of your best friend signal. Best friend Morningstar type 6. Okay. Thank you for showing up tonight. We will see everybody bright and early tomorrow morning. See you then.